Hello and welcome to Market Call. I'm Mark Bunting. For the next hour, we have David Burrows on the program, President and Chief Investment Strategist at Barometer Capital Management. He's taking your questions on North American large caps. So there are three ways to reach us, and then we'll add a bonus one for you in just a second. There's the toll-free number. You can email us or use Twitter at Market Call. A reminder that you can now upload a video question. Log into your Twitter or Instagram account, videotape a quick question, and then tag us in your post, and your question can be answered by one of our guests, like David, during a show. Hello, sir. How are you?
I'm great, thanks. How are you?
Very well. Good to see you. And I was just talking on the air a few minutes ago about one of the big overriding stories, and I'm guessing you'll agree, for financial markets, the strength of the U.S. dollar, weakness elsewhere, a divergence among central banks. Does that affect your thinking a lot and how you invest for clients?
So Mark, you know that we are very thematic in the way that we invest. It's all about finding sectors or themes where something is changing that could lead to some tailwind that cause revaluation. And so the US dollar has probably been the biggest theme in the market over the last 6 months. It's catching everybody's attention right now because it seems to be accelerating a little bit. But it's a huge win for the US consumer. It is a win for certain industries, and it's a headwind for certain parts of the world. And largely, there has been a very high correlation between a strong US dollar and a strong US stock market. They were tightly correlated all the way through the 80s and 90s, and they've been tightly correlated for the last year. The risk in it is that if the dollar moves too quickly versus, say, emerging market currencies, which make up about 65% of the dollar index, it makes it very expensive for companies to pay their debts in those countries if they've raised money in US dollars. So in 1998, we know the dollar moved very rapidly. There was an Asian currency crisis, and that caused a pretty good hiccup in the market. I think that's probably the biggest risk in this market because emerging market debt has been quite weak recently, and emerging markets are underperforming because of weak commodity prices. They got weak commodity prices on one side and expensive debt on the other. For the US stock market, that poses a risk sort of from the periphery, but ultimately it's a good thing for the consumer, for instance, and for technology companies and mid-sized companies that are more focused on the US domestic economy.
So you're focusing on those types of sectors, domestic-oriented companies?
We're in one of those magic markets where, as a manager who's targeted, there are some very clear positive themes, and there's some themes that you want nothing to do with. The difficult thing for Canada is some of those themes that are having a tough time are big parts of the Canadian market. So it means the Canadian market probably underperforms for some time. And you really, as a manager or an investor, can pick your spots, behave very differently than the index, and probably get some pretty good outsized returns relative to the market.
You're always very attuned to fund flows. Where are things flowing right now, and what's being rotated out of?
So first and most importantly, money globally is working its way into the equity asset class. So multiples are expanding. Specifically, it is consumer-led developed markets that are the winners. So for instance, the US, Japan is another example. India is another example. These are all countries that historically, well, certainly Japan and India, that imported a lot of commodities. And so low commodity prices are a win, or low energy prices are a win. So consumer-led developed economies are the number one. Money is starting to work its way out of bonds. It's certainly working its way out of commodities. We believe that we've entered probably a 10-year period of underperformance for commodities. And so that has some, sector ramifications.
And just lastly, are you seeing money flow into Europe? Do any of those companies interest you?
Yeah, absolutely. Europe is the beneficiary of flows. We track the percentage of stocks in particular universes, like say Europe, that are performing well from a price perspective. And in a healthy market, the percentage of stocks doing well should be expanding. And that clearly is happening in the US, it's happening in Europe. The one thing we have to keep in mind, though, is that the euro is under some pretty extreme pressure. So unless you can invest and hedge the currency risk, it's a problem. So for us, we can hedge currency. For an investor, they could buy an ETF like HEDJ, which is Europe currency hedged back to dollars. Unhedged is probably not that attractive.
All right, David, very good. Nice overview there from David Burrows. He will drill down on your questions on North American large caps after this.